Dear Sir, Madam Professors from Golden Gate University, today we would like to present our assignment 2. We come from Group 5 from Vietnam. We have totally 5 members, which are the first one is Nguyễn Như Tâm Bình, the second one is Miss Trần Thị Thanh Tuyền, the third one is Miss Đỗ Thị Kim Hoàng, the fourth one is me, Lê Đức Tùng, and the fifth one is Nguyễn Ngọc Thi Loan. And we would like to come up with the topic, interpret and compare the performance of Costco and Walmart companies. As you can see on the screen, we have the table of content. This part we included three parts. The first one is introduction, and the second one, 2.1, is profitability, which is presented by Miss Như Tâm Bình Nguyễn. The 2.2 is liquidity, that presented by Miss Tuyền Trần, and the 2.3, which is the part efficiency, divided into two people presented. The first one is total asset turnover ratio, 2.3A, and 2.3B is fixed asset turnover ratio, that which is presented by Thi Loan Nguyễn, and 2.3C and 2.3D, which is presented by me, Mr. Tùng Lê, and the part 2.4 leverage, which is presented by Ms. Hoàng Đỗ, and the last part conclusion, which is presented by me. So we will go to the first part, in introduction. As you know, the financial performance of Costco and Walmart offers valuable insight into their operation strengths and market positions. By examining key metrics like profitability, liquidity, efficiency, and leverage, we can evaluate each company's ability to generate income, manage cash flow, optimize asset utilization, and handle debt. Profitability reflects their income generating capacity, while liquidity assesses their ability to meet short-term obligations. Efficiency shows how well they utilize resources, and leverage reviews their debt to equity balance. Comparing these metrics provides a comprehensive view of how Costco and Walmart navigate the retail sector's competitive landscape, shaping their growth potential and financial stability. The next part is profitability ratios, which is presented by Miss Như Tâm Bình Nguyễn.
Yeah, thank you, Mr. Tùng, for your introduction. Okay, so now we will come to the profitability ratios. For profitability ratios, we are going to compare 5 factors, including net profit ratio, operation profit margin, return on total assets, and return on common stock. As you can see on the slide, the data sources will be based on 2024 annual report of each company. First of all, we now compare the net profit ratio of the two companies. Based on the annual reports of each company, we have net income and net sales in value, as you can see on the red circle. So now on the table, we can see that net income of Walmart is about double in comparison with net income of Costco. However, net profit ratio of Walmart is only 2.4%, while the net profit ratio of Costco gained is 2.9%. So it dictated that even though Walmart earned more than Costco in value, but the sales earning generated from each dollar of Costco is more than Walmart. And both companies are higher than the industrial ratio, which is only 2.3%. However, net profit ratio of Walmart dropped from 2022 to 2023, and then increased a little from 2023 to 2024, while Costco got a stable increasing of net profit ratio through years. Now we come to another factor of profitability, that is operation profit margin. As you can see on the table, the operation profit margin of means OPM of Walmart is about is 4.2%, which is a little higher than the ratio of industry, which is 3.6%. And compare with the Costco, it seems that the OPM of Costco is the same with industry ratio. So it means the Costco is the same with industry ratio in terms of controlling the expenditure. And the OPM of Walmart is higher, so it means Walmart is better to control and optimize their expenditure, especially in terms of cost of goods sold. So the third ratios, now we compare the return on total assets, means ROA. So the numbers show us that the ROA of Walmart is 6.1%, which is a little higher than the industrial ratio, which is 5.9%. However, as you can see on the right column, the ROA of Costco is much higher than not only the Walmart but also the industry ratio. So it dictated that most of total assets of Costco had not been renewed. Costco is much more efficient and maximizing the benefits getting of its assets to generate profits. And both companies are efficient in comparison with industry ratio. Finally, we will come to the return on common equity, means ROE. So in terms of ROE, the Walmart is 18.5%, a little bit lower than the ratio of the industry, which is 20.6%. And Costco is much higher than the ROE of not only Walmart but also the industry ratio. As you can see, the ROE of Costco is more 1.6 times higher than ROE of Walmart, and the ROE of the industry ratio. It dictated that the return for every US dollar invested in Costco is much higher than Walmart. And even both ROE of the two companies grew from 2023 to 2024. However, the ROE of Walmart is a bit lower than industry ratio. So in conclusion, in terms of profitability, Costco is better to optimize their resources to generate profit. This is because not only net profit ratio, but also return on total assets and return on common equity. Costco also have better in those three factors. In terms of OPM, Walmart is better, get higher OPM ratio. It means that Walmart is better for operational management, and it seems that Walmart has better cost of goods sold, as well as better gross profit from sales made. However, with a smaller and less store, less employees, as well as lower inventory stocks, Costco has much better ROA. Both companies are having high ROE, but I think we need to look at retention ratio and sustainable growth rate to investigate more. So that's all for my side. Now it's turn of Mr. Tuyền for the liquidity. Yeah, thank you.
Thank you, chị Bình. So now we are gonna look at the liquidity ratio. So we will have three main factors. The first one is current ratio, and the second one is a quick ratio, and the third one is a cash ratio. And let's gonna look at them. And for the first one, we have overview. Let's look at the table. You can see that Costco liquidity ratio has remained stable in recent years. Until in 2024, it has dipped compared to the same period in previous year, but it still surpasses that of rival Walmart. And for the detail regarding to the current ratio, as you can see the pie chart and the table, we can guess that we can see clearly that Costco current liquidity ratio is totally better than Walmart and the market average, even if it declines into 2024, but the balance between total assets, current liabilities, and inventories shows that Costco's ability to cover its current liabilities is well controlled. And about Walmart, this ratio is quite risky, and we can see that the value of inventories account for about 2/3 of the value of assets, indicating a risk in the cash conversion cycle, while the current debt ratio is also worrying because it is higher than total assets. And you can look at the number, you can see that the current debt is about, like 92 and 415 versus 76 1,877. And for the quick ratio, and you can see that the given characteristics of a retail industry is normally inventories constitute a significant portion of assets and influences ability to quick generate cash when needed. The data indicates that even when including inventories, Costco quick liquidity ratio remains strong in comparison to its competitor, Walmart, and the overall market. And the third one, the last but not least, cash ratio. And with the current volatile economic situation, especially in the retail consumer good industry, and we usually see that inventories is slow to sell and receivable are difficult to collect as before. And when we look at the data table and the bar chart shows that Costco's cash liquidity is completely superior to Walmart's, along with Costco cash to current liability ratio of about 11%, while its competitor Walmart is 31%. So we can clearly see that Costco's ability to buy short-term debt with cash is better than Walmart and the general level. And now we can look at the efficiencies represented by Miss Luang. And let's start.
Yeah, thank you, Miss Tuyền. Okay, so right now I will share my slide. Wait for what? Can you see my slide? Oh, see. Okay. Hi everyone. Yes, I think I will share my slides. It's better. Okay. So, hi everyone. I will continue presentations of our team. So now we move to the next part, efficiency ratios. Typically, it's used to analyze how well a company uses its assets and liabilities internally. Besides, an efficiency ratio measures a company's ability to use its assets to generate income. For example, an efficiency ratio is often looked as various aspects of the company, such as the time it takes to collect cash from the customer or to convert inventory to cash. This makes efficiency ratio important because an improvement in efficiency ratios usually translates to improved profitability. Now we will integrate and compare the performance of Walmart and Costco in efficiency ratios. First of all, total assets turnover ratios. It is a financial ratio that measures the efficiency of a company's use of its assets in generating sales revenue or sales income for the company. According to the statistics from stock analysts on net, the ratios from Costco is higher than Walmart from 2019 to 2024, indicating that Costco used its assets in generating sales revenue or sales income for the company more effectively than Walmart. However, they both generally develop slightly every year, showing that the company is becoming more efficient. Besides, there is another financial metric used to evaluate a company valuations based on its earnings. That is right earnings ratios. It can provide insights into how the market values a company's future earning potentials, which can influence by the company's long-term assets and growth prospects. We collected the number from financial report from these two companies and calculated these ratios. The ratios from Costco is higher than Walmart from 2022 to 2024. Following this number, we can understand how the general public thinks of this stock. Now we will go to the fixed assets turnover ratios. These ratios indicate how effectively a company utilizes its fixed assets to generate sales revenue. As you can see the information displayed in the slide, the ratios from Costco is higher than Walmart from 2019 to 2024, indicating that Costco used its fixed assets in generating sales revenue more effectively than Walmart. The next ratios that had to do with efficiency is property, plant, and equipment turnover. This is a measure of how efficient you are at generating revenue from fixed assets, such as building, vehicle, or machinery. PPE turnover of Costco is higher than Walmart, pointing out that Costco generated revenue from BB more effective than Walmart. Besides, they are in the same trend, like slightly increasing from fiscal year 2022 to fiscal year 2023 and decreasing in fiscal year 2024. Now we move to the next category, which is presented by Mr. Tuk.
Okay, thank you, Ms. Wang, for your introduction. So we come up with our part, which is efficiency, but we continue with the next metrics. Okay. For my part, we present two parts, which is the first one, inventory turnover ratio, and the second one is account receivable turnover. As you know, the current asset turnover ratio have the formula, as you can see on the screen, which is net sales divided by average current assets. And Costco current asset turnover ratio is not to be higher, sitting around 3.67 for 2024, which indicates strong efficiency in using its asset to generate sales. This is consistent with Costco high revenue turnover and is focused on a membership based high volume sales model, allowing it to maximize asset usage effectively. And on the other hand, Walmart's current asset turnover ratio is slightly lower at approximately 2.61. While Walmart also operates efficiently, the difference reflects its larger scale and variety of operational models, such as its expanded e-commerce footprint, which influence its asset utilization rate slightly differently than Costco warehouse style model. The index 3.67 and the index 2.61 for the current asset turnover ratio, I take from the source stockanalysis.com, as you can see on the screen. Next, for the inventory turnover ratio, we have the formula cost of goods sold divided by average inventory. As you can see on the screen, the inventory turnover ratio is a measure of how efficiently a company sells and replaces its stock within a certain period. Comparing Costco and Walmart, Costco's inventory turnover ratio is significantly higher than Walmart, which reflects differences in their business models and operational efficiency. And for the inventory turnover ratio, as you can see on the table, this index I take from the source stock data online. So the inventory turnover have the formula cost of revenue divided by inventory that I just mentioned, and we take the index from the table at approximately $245 billion divided by $18 billion. We have the number 13.15. So from this number, we realized that inventory turnover ratio of Costco of 13.15 for fiscal year 2024, meaning inventory is sold and replenished around 13 times annually. This high ratio reflects Costco focus on a limited range of high volume items and its warehouse model, which promotes faster inventory movement. Okay, so we come up with the table from Walmart with the same formula that I just mentioned for the inventory turnover. So I take, we have the index 8.93 for 2024. So we can see for Walmart inventory turnover ratio of 8.93 for 2024 indicates inventory is recycled approximately 9 times a year. Walmart's broader product range and extensive store network contribute to a lower turnover compared to Costco. So for the comparison for the inventory turnover ratio between Walmart and Costco, we have the conclusion, which is Costco's model supports faster turnover, while Walmart's diverse products offering results in a slower yet solid turnover rate. So we come up with the 3.B part, which is receivable turnover ratio. We can call it account receivable turnover. So we have the formula for this index, which is net credit sales divided by average account receivable. So The account receivable turnover ratio, which measures how efficiently a company collects revenue from its credit sales, shows a significant difference between Costco and Walmart company. So we will make it clearly by the chart that you can see on the screen that I take from the source on unfaquery.com. So we see the Walmart receipt turnover ratio is at 73.68. From this index, we observe that Walmart has a high accounts receivable turnover ratio, which is at the index 73.68, indicating rapid collection of payments and efficient cash flow management. So how about Costco? For the Costco Wholesale Corporation, we see it has the number at 93.51 for receivable turnover ratio. So we can realize that for Costco, the fiscal year ending August 31st, 2024, Costco had an account receivable turnover ratio of 93.51. This high ratio indicates that Costco is highly effective in extending credit and collecting debts from its customer. So what we can realize, we can learn from the comparison between Costco and Walmart for the receivable turnover ratio, which is why both companies manage receivables well. Costco operates at a significantly more efficient level, highlighting its strong operational capabilities in this area. So, and the next part, we will learn more deeply about the leverage ratio, which is presented by Ms. Hoàng Do.
Hello everyone. My name is Hoàng Do. Today I'm very honored to be present about the leverage ratio. Let me share my screen. You see my screen? Now I can start.
Yes.
Leverage ratio. I would like to say 4 kind of leverage ratio. That is debt to equity ratio, financial leverage ratio, interest coverage ratio, fixed charge coverage ratio between Costco and Walmart. First, I want to show leverage ratio between Costco and Walmart in overview. Costco has a lower depth of liquidity and ratio compared with Walmart. And the information we can see Costco rely less on debt financing and had a stronger financial position in terms of debt. Besides that, the financial leverage ratio for Costco and Walmart have been relatively stable over 5 years, with a slight increase in 2020 and finally having a degree in 2024. Besides that, as I say, Costco has a higher interest rate and fixed charge coverage ratio than Walmart, and that also can show Costco in much better position to meet an interest and fixed payment obligation better. We can see debt of equity ratio of Costco we can say Costco wholesale with debt of equity ratio improved from 2022 until 2024. And we also can see debt of equity ratio of Walmart. This ratio deteriorated from 2022 to 2023, but slightly improved from 2024. Now we can compare recent of debt of equity ratio between Costco and Walmart in 5 years. Which Costco started ratio 0.48 and reduced only 0.31 in 2024, and this ratio is lower than Walmart. So we can see Costco is less reliant on debt to finance its operation than Walmart. And but finally, as I say, both Costco and Walmart has seen a decline in their debt to equity ratio over in 5 years. Now I want to show comparison of finance leverage ratio between Costco and Walmart. As you can see, Costco financing leverage ratio is lower than Walmart during 5 years. Only in 2022 and 2021, it is slightly higher. So that suggests Costco had lower debt burden related to its asset compared to Walmart. So overall, this analyst revealed that Costco had a lower financial leverage ratio compared to Walmart in most year. That also shows Costco had a lower debt burden than Walmart. The next, I can show comparison of interest coverage ratio between Costco and Walmart. We can see Costco has significantly higher interest coverage ratio compared to Walmart on 5 years. This also suggests that Costco is in a much stronger financial position to meet its interest expenses. And we also can see Costco always have stronger financial position than Walmart. And that also demonstrates its financial stability and lower debt burden. Then I can compare between Costco and Walmart about fixed charge coverage. This ratio calculate as earning before fixed charge divided by fixed charge. And as I go inside, I can see Costco has significantly higher fixed charge coverage ratio compared with Walmart on 5 years too. This also suggests that Costco is in a much stronger financial position to meet its fixed financial obligation compared to Walmart. In conclusion, I can say after analysis between Costco and Walmart, both have subject a stronger financial footing for both companies. But when we analyze in detail, Costco and Walmart, I see Costco appears to have a stronger financial position than Walmart. And Costco also has lower debt ratio and higher coverage ratio, suggest a lower risk of financial distress, and Costco has a greater ability to withstand economic downturn. That is on my information to show about leverage ratio between Costco and Walmart. Thank you. And
Thank you very much,
yeah.
Ms. Doti Kim Hoang, for your part. So the next part is the conclusion part. So we are on go through the very detailed part which is presented by all of our members from Profile from Vietnam. So I would like to make the conclusion about this topic. So in the conclusion, analyzing profitability, liquidity, efficiency, and leverage reviews the distinct strengths and strategies within Costco and Walmart's financial performance. Costco demonstrates strong efficiency and profitability due to its unique membership model, which promotes consistent revenue streams and operational cost effectiveness. Walmart, however, leverage its vast scale for high sale volume, contributing to solid liquidity and resource management. Both companies, you can see, use leverage effectively to support expansion. Though Walmart exhibits a higher debt ratio due to its expansive store network. Overall, each retailer's approach reflects its strategic priorities, influencing its resilience, market adaptability, and long-term growth prospects. So we just make the presentation about the topic, interpret and compare the performance of Costco and Walmart companies. So thank you very much, Sir, Madam Professor from Golden Gate University for listening carefully to our presentation, Group 5 from Vietnam. Thank you very much.
Thank you very much.
Goodbye.
Thanks, Kim.